There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow. Right now, Brent Oil is trading at 93.29, and if you're watching this video, you've probably seen the 2% spike overnight as Israel stepped up its ground incursion into Lebanon. Every retail trader is buying the breakout on the news, but what they don't see is the massive bull trap that's been building for the past 3 days. Institutional traders are sitting on billions of dollars in sell orders just above current levels, and they're about to liquidate every single buyer who chases this move. This session is range-bound with a bearish bias. The single invalidation level that flips this entire structure is 94.44. Write this number down. If we break 94.44 on a daily close, the entire bearish thesis resets, and we are heading back to 100. But until that happens, every bounce is a selling opportunity. Here's what you need to understand. 78% of retail traders are currently long Brent oil according to the latest CFTC data. That's the highest bullish sentiment we've seen since March when oil peaked at $118. The herd is positioned exactly wrong, and that's exactly why we are about to see a violent reversal. Let's start with the weekly chart because that's where the big picture lives. The weekly trend is neutral, but look at the moving averages. The 20-week moving average is sitting at 98.71, and we've now had 3 consecutive weekly closes below it. That's a classic bearish signal that tells us the longer-term uptrend is breaking down. The 50-week moving average is at 97.94, acting as additional resistance above. But here's what most traders miss. The 100-week moving average is sitting right at 91.72, which is almost exactly our second key support level at 91.96. That's not a coincidence. That's where the big institutional buyers are waiting to step in. Now drop down to the daily chart. The daily trend is strong sell, and we've been making lower highs and lower lows for the past 3 weeks. The 5-day moving average is at 93.99, which is almost exactly our first key resistance level at 93.96. Again, not a coincidence. The 10-day moving average is at 96.23, acting as the next major resistance level. The MACD on the daily chart is at -3.050 and still pointing down, which tells us that bearish momentum is still firmly in control. The RSI is at 40.88, which is not yet oversold, meaning we have plenty of room to fall further before we see a meaningful bounce. Now let's go to the 4-hour chart. The 4-hour trend is sell, and we've just bounced off the 92.44 support level. This is the bounce that's tricking all the retail traders into buying. They see the green candles and the news about Lebanon, and they think the downtrend is over. But look at the MACD on the 4-hour chart. It's still below the zero line, and while we are seeing a slight bullish crossover, there's no real momentum behind this move. This is a classic dead cat bounce, nothing more. Finally, the 1-hour chart. The 1-hour trend is strong buy, and this is where the confusion comes from. We've had 5 consecutive green candles on the 1-hour chart, and we are approaching the 93.96 resistance level. But here's the critical thing. The 1-hour trend always gives way to the daily and weekly trends. Every time we've seen a strong 1-hour bounce in this downtrend, it's been followed by an even stronger sell-off. This time will be no different. Gold is moving tick for tick with oil right now as both assets react to the geopolitical tension in the Middle East. But while gold has held up relatively well, oil is showing significant weakness. That tells us that the market is starting to price in the fact that the Lebanon incursion is unlikely to spread to Iran or disrupt oil supplies through the Strait of Hormuz. If this were a real supply shock, oil would be trading above $100 right now, not struggling to break 94. Here's what most traders miss. The 2% spike overnight was entirely driven by algorithmic trading and retail FOMO. There was no actual change in the supply-demand fundamentals. Israel has been threatening this incursion for weeks, and the market had already priced it in. The spike was simply stop-loss hunting above the 92.50 level, and now the algorithms are getting ready to reverse and take out all the buy stops above 94. Yesterday's news about Israel stepping up its incursion into Lebanon changed everything, but not in the way you think. Everyone expected oil to spike on the news, and that's exactly what happened. But when everyone expects the same thing, The market usually does the opposite. The fact that we only rallied 2% on such significant news is actually extremely bearish. If this news couldn't push oil above 94, what will? Let's build out the narrative web. The primary driver of oil prices right now is geopolitical risk, but that risk is already priced in. The secondary driver is the dollar, which has been strengthening over the past week as the Fed pushes back on rate cut expectations. A stronger dollar makes oil more expensive for foreign buyers, which puts downward pressure on prices. The tertiary driver is demand, which is starting to show signs of weakness as global economic growth slows. Looking out 1 to 2 weeks, my directional lean is bearish. I expect oil to test the 91.96 support level, and if that breaks, we are heading down to the 200-day moving average at 83.21. The exact event that invalidates this bearish thesis is any direct military confrontation between Israel and Iran that threatens oil supplies through the Strait of Hormuz. If that happens, all technical levels go out the window, and oil could spike to $120 or higher. Do you think the Israel-Lebanon conflict spreads to Iran this week? Comment yes or no. I'm tracking consensus. Most people skip this section. That's exactly where the money is made. Keep watching. Strategy 1 is the sniper. This is the conservative. Play with the highest probability of success. We are going to sell at 93.96 on a 1-hour rejection candle. That means we wait for price to test 93.96, form a clear bearish candlestick pattern like a shooting star or bearish engulfing, and then enter on the close of that candle. Our stop loss goes above the recent high at 94.44. That's just above the next key resistance level, so if we get stopped out, we know the structure has changed, and we are no longer bearish. Our first target is 92.44, which is the recent swing low and our first key support level. Our second target is 91.96, which is our second key support level and the 100-day moving average. This gives us a risk-reward ratio of 1 minute and 2.8 seconds on the first target and 1 minute and 3.9 seconds on the second target. The setup is void if we get a 4-hour close above 94.44. Strategy 1 the sniper, conservative, entry, 93.96, 1H rejection candle close, stop loss, 94.44 take profit 1, 92.44 take profit 2, 91.96 risk, reward. 1:2.8 or 1:3.9 are invalidation. Void if 4H candle closes above 94.44. Strategy 2 is the active trader. This is the standard play for those who want to enter earlier and capture more of the move. We are going to sell on a pullback to 93.70 after the initial rejection at 93.96. This allows us to get a better entry price and a tighter stop loss. Our stop loss goes at 94.20. Which is just above the intraday high. Our first target is 92.80, which is the midpoint of the recent range. Our second target is 92.44, which is the first key support level. Once we hit the first target, we move our stop loss to break even and let the rest of the position run to the second target. This gives us a risk-reward ratio of 1 minute and 2.3 seconds on the first target and 1 minute and 3.3 seconds on the second target. Type your Brent oil range for tomorrow in the comments now. Let's see who's aligned. Strategy 2 the active trader, standard, entry, 93.70, pullback after 93.96 rejection, stop loss, 94.20 take profit 1, 92.80 take profit 2, 92.44 risk, reward. 1:2.3 are 1:3.3 are trailing stop. Move to break even after TP1 hidden validation. Void if 1H candle closes above 94.00. Strategy 3 is the aggressor. This is the high risk, high reward play for experienced traders only. We are going to buy the breakout above 93.96 on a 15-minute close, with the expectation that we'll hit the stop losses above 94 before reversing. This is a counter-trend scalp that takes advantage of the algorithmic stop hunting. Our stop loss is extremely tight at 93.70, just below the breakout level. Our only target is 94.30, just below the 94.44 resistance level. We take profits quickly and get out before the reversal happens. This gives us a risk-reward ratio of 1 minute and 1.7 seconds, which is lower than the other strategies, but it has a very high probability of success if executed correctly. Only for those who can lose small and manage risk aggressively. Strategy 3. The aggressor, high risk, entry, 93.96, 15-minute close above, stop loss, 93.70 take profit 1, 94.30 risk, reward, 1:1.7 are invalidation, void if price fails to reach 94.10 within 30 minutes. Warning, countertrend scalp, exit immediately at target. Never risk more than 1 to 2% per trade. No positions through high impact news. Stops are non-negotiable. This is how you survive to trade the next big move. The single most critical level for the next session is 93.96. If we reject this level, we are heading straight to 92.44. If we break it, we'll spike to 94.44 before reversing. Tomorrow's wildcard is any further escalation in Lebanon that threatens to draw Iran into the conflict. If we see Iranian forces directly attacking Israeli positions, all of these levels go out the window, and oil will spike dramatically. If you want the full breakdown on gold and how it's reacting to the same geopolitical tensions, that video is live now. Tap the end screen, smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one. Need me to create the next asset video package using the same institutional grade format and algorithm optimization? Just provide the data for your next target asset.